Good morning and welcome to today's webinar, Financing Options for Exporting. This event is brought to you by the Pacific Northwest Defense Coalition and Banner Bank. We will begin the presentation in just a few moments. I'd like to confirm that everybody can hear me okay on the line and see the screen. If you're joining us online, will you please just use the question tab and type in yes if you can hear me okay, or let me know if there's any concerns. Great, thank you. You will have a chance to ask questions during today's broadcast. If you have a question at any time, type your question in this same question tab and we will get that to the speakers today. There is a copy of today's PowerPoint presentation as well as a list of upcoming PNDC events available in the handout tab. We'll go ahead and begin now. I will turn things over to Brad Burkholz, Vice President Relationship Manager Commercial Banking with Banner Bank, who will be moderating today's program. Brad, go ahead and take it away.
Thank you. I'm pleased to introduce today's speakers on behalf of Banner Bank. Banner is a PNDC member with a strong trade finance group, so it's a great fit that we sponsor today's webinar. At Banner, we will celebrate our 126th anniversary this year, so we understand what it means to grow a successful company, and we work hard to help our clients to do the same. Our speakers are going to provide an overview on the financing options for export-related sales. First up will be Joe Timmons, VP and Trade Finance Consultant of Banner Bank. He will lead off with a discussion about documentary collections and letters of credit. Joe will be followed by Mabel Lewin, Western Regional Director of the Meridian Finance Group. Mabel will share how credit insurance can support open account export sales. John Brislin, Director of the Seattle office of the Export-Import Bank, will outline financing options available with the assistance of the EXIM Bank. We will finish with Jim Newton, International Trade Finance Specialist and Regional Manager for the Small Business Administration. Jim will share the financing options available with the support of SBA export-related programs. This is an outstanding lineup. They are all very experienced in their respective fields and excellent resources, so let's get going.
Good morning, everyone. My name is Joe Timmons. I am from Banner Bank's Trade Finance Department. I sit in Seattle, Washington for Banner Bank. We have a footprint now that includes California, Oregon, Washington, Idaho, Utah, and we are in the midst of growing our international department for the expanded footprint that we've captured this last year. You can see my address on the slide. My phone number is at the end of the slide. I'm open for any questions anytime you need anything. Please feel free to reach out to us. On the next slide is just a brief overview of what we're going to talk about as far as some banking products today. It's a great panel of speakers. I know everybody on the phone here, and all of our products can be used together in one way or another, or to support each other. Letters of credit, standby letters of credit, and commercial, also known as the documentary letter of credit, and then documentary collections. Get right into the definition on the next slide is definition of any letter of credit. You have to remember it's an irrevocable instrument issued by a bank on behalf of its clients. It authorizes a third party, the beneficiary, to draw a specific amount for a specific time period against presentment of required documents. So no matter if we're talking about a standby letter of credit or a documentary letter of credit, that's what we're talking about. It's the bank substituting their creditworthiness for their client. Bank obligation, very important. And the word irrevocable, you can't miss that on the page. It's hopefully it's spelled correctly, but they can't pull the rug out from under your feet on the letter of credit. So we're going to talk first about standby letters of credit on the next slide. Standby letters of credit, I wanted to start with those because often your business transaction could start with some sort of a bid or an obligation for you to perform. The standby letter of credit is intended to be a default mechanism. It's not necessarily the payment mechanism. It is in case a party fails in the transaction. So I have here our client, the account party. If they do not do what they agreed to, the beneficiary can demand payment from the bank. So it's similar to a bond. I have a sample of what a typical standby letter of credit could look like as far as what a default standby is. Think of it as a financial backstop for the relationship where a document could be required. In this case, Dr. Brown and Company has defaulted on their obligations under the agreement number 88 dated October 21st, 2015 concerning the supply and installation of a flux capacitor. So you can see it can be any type of arrangement that you wanted to secure. Your performance, whether it's a performance or a financial obligation you have with another company. On the next slide, there are some typical examples of what you may see standby letters of credit used for. Bid bonds. I think it's loading a little bit slow. Performance bonds, advanced payment bonds, warranty bonds. So those first few, okay, so you're entering into to present your bid for a contract. If you win the bond, if you win the bid, you may have to include a bid bond under a standby letter of credit. Often works for those to let your customer know that if you fail to perform per that bid when you win the bid, they can demand some of their money to recoup their losses for their time and efforts. And it's the same for a performance bond. Often used, performance bonds are often go right into the advanced payment bond and a warranty bond. And I know some others on the phone will be speaking of those today. We also issue these standby letters of credit to support local guarantees in other countries. Overseas, they have a tool that it's a bank guarantee. Banks in the U.S. aren't very hot on issuing them. I've never issued one. I think we're pretty much forbidden. However, banks in other countries are often using guarantees, and we have the ability of issuing a standby letter of credit to a foreign bank and asking that bank to issue a local guarantee. So if you ever come across any of those requirements from any of your buyers, there is a way to get those done. The vast majority of standby letters of credit are probably domestic transactions, unpaid invoices, or supporting leases or insurance. So I just said plus many more. Use your imagination on anything that could be needing a standby letter of credit to guarantee performance or a financial obligation. So that'll conclude the standby letter of credit portion. We'll go right into the commercial letter of credit. Also, I call it commercial letter of credit, often referred to as the documentary letter of credit. These are the payment mechanism for your transaction. And I've listed two names, and they're the same thing, import letter of credit and an export letter of credit. When we're exporting, we're calling that letter of credit an export letter of credit. But your buyer overseas has issued an import letter of credit. Same letter of credit, it's just which way the goods are flowing, which way the money's flowing, and what side of the letter of credit you're on. But it's the same letter of credit. So a better term is documentary letter of credit for an exporter. We flip to the next page, and I've listed the typical benefits of a commercial or documentary letter of credit. For your buyer, remember, the letter of credit is the bank substituting their creditworthiness for their client. So the buyer overseas has their bank issue the letter of credit on their behalf, compels the seller, you, to ship the product, maybe start the production of the product and ship the product without a prepayment, because you have an irrevocable commitment from that bank for payment if you comply with the terms of the letter of credit. Some more of the benefits: the buyer knows that there's certain conditions within the letter of credit that must be met, and that must be evidenced by the documentation required. And don't worry, because we're going to go through really quickly typical letter of credit, just so you get a feel for what we talk about when we're looking at a documentary letter of credit. Some of the benefits for the exporter: if you comply with the letter of credit, your documents comply, you've made the shipment, prepared the documents, no discrepancies on your documents, you'll be paid. You have the bank risk instead of your client's risk. Reduces production risk since the LC is irrevocable. You have a commitment from a bank, so you can start that production well in advance of shipment once you have that letter of credit in hand. Usually faster payments, and there's a certain amount of control of the title to the merchandise when you're shipping under a letter of credit. The banks are holding the documentation, so you're not sending your original documents directly to your buyer. And lastly, knowledge that the buyer has a stakeholder, it becomes a stakeholder with skin in the game. So to get a letter of credit issued, a company must have a pretty good relationship with their bank, probably a line of credit or credit facility of some sort. So it does demonstrate that your buyer has some creditworthiness and sophistication. Remember, on the next page, letters of credit deal with documents only, not with the actual goods. So payment relies upon presenting documents that comply with that letter of credit. So let's take a look at typical terms and conditions found in a documentary letter of credit. You know, these are the ones that you're really going to see, the main ones. And none of this should be, I was going to say foreign, but should be new for you, because all of this information is in your contract in one way or another, in your sales contract or the purchase order. Most of the information. The bank assigns the documentary credit number. That's the letter of credit number. But if we flow through this, the applicant is your buyer. The beneficiary is you. It lists the exact dollar amount of your product. And if you're scrolling down the list on the left-hand side of the page, these are the typical SWIFT fields that a letter of credit is formatted under for the SWIFT communication. So it's a very standardized instrument with all of the typical fields being in every letter of credit. Very important, available with and by any bank in the U.S. by negotiation. That's field 41. That way you can take your original letter of credit to any bank you'd like and work with that bank. You're not restricted to the bank that advised the letter of credit to you. When we flip to the next page, the letter of credit, you're specifying what ports the shipment will leave from and go to, the latest date of shipment, your complete description for your sales contract, and here are the documents required. Signed commercial invoice, packing list, bill of lading, typical documents. Now, your product may be very specialized, which I'm sure it is, and you'll have specific documents that your buyer will need. But those are the typical documents that you're going to see in every letter of credit. And then on the next page, we have additional conditions where, you know, there might be some extra conditions. They want to see a letter of credit number or an import application number on every document. If all letters of credit are currently subject to the UCP 600, which are the rules that govern letters of credit. Every banker, no matter what country they're in, will be using the same set of rules, so it's good to be familiar with those. We can give a breakdown of charges between the buyer and the seller, all spelled out in the letter of credit. So if we go to the next page, I know I'm almost through to the end of this, so I'll keep plowing ahead. Some solutions where we've seen folks have a hard time with letters of credit. Sometimes letters of credit get a bad name, and this list, if you take some time to read it, can help you out. And you're always welcome to give me a call or anyone here at Banner. When you're negotiating the contract with your client, contact your banker and review their LC process and pricing, so you know ahead of time what that letter of credit is going to cost. Review your client's letter of credit application or draft of the LC. Often get your banker involved with that and ask them the questions. Like I said, limit the documents required under a letter of credit, because documents, the more documents, the more complicated the letter of credit can be. So if you want to keep it simple, that's the best. Ask your banker to spend some time, review the contract, the letter of credit draft. It's something we do at Banner. Do not use your standard accounting system to generate documents for a letter of credit. Get out and get your invoice packing list, all of your documents done on Word or some type of word processing program. Often in the accounting software documents, there's unneeded information, unnecessary, and it can really add discrepancies. And then find someone in your company that you want to designate as a letter of credit specialist and get them into these types of training. Have them work with your banker. We're more than happy to get your folks up to speed on letters of credit. It can really simplify everything and take the heartache out of letters of credit. That's what we're here for. Have your partners know that you're shipping under a letter of credit. Your freight forwarder needs to know. Hand them a copy. Your insurance company, your logistics department. Keep everybody informed that you're using a letter of credit. Another service we offer is we review preliminary documents prior to you producing the original. So when you gather all your documents in a draft format, when shipment's made, you can hand them to us and we'll take a look at them and make sure they comply with the letter of credit. Quickly, I'll go through documentary collections because they're very similar to a letter of credit as far as the underlying transaction. You're still ship the product. In this case, there's no bank obligation to pay, but there is an obligation of the banks. You would still prepare your invoice packing list and all of your documents required by your buyer. You would send them into the bank for your bank to forward to your buyer's bank on a collection basis. Now what that does is it keeps the documents, the title of the goods, within the banks, so you still have control, but your buyer's bank cannot force their client to pay. They simply notify that the documents are there. That bank will not release documents without your client agreeing to the payments of the collection. So it is a nice way to do business, especially if you have a good relationship with the client. So there's two types. You could have documents released against payment, which is more secure than documents released against acceptance, where there's a term, payment terms, maybe 60, 90 days after the shipment date. Again, there's no bank obligation for the payment. There's no undertaking for the payment. It's simply the bank is facilitating the trade and holding documents. So if we look at the next slide, the payment methods, and I believe we all have a slide very similar to this. If we look at the top part of that, that's the exporter's risk from left to right, left being the least secure and right being the most secure for the exporter. If you're shipping open account, a lot of risk. You're shipping a product waiting for payment. I know we're going to hear some great solutions for that. soon as I'm done here. Documentary collections are a little bit farther to the middle. Letters of credit do reduce your risk, but certainly not as much as cash in advance. And then you can see it's the exact mirror image for your importer. So you can understand where they're coming from as well. So on the final page of my slide is a little bit about Banner Bank and our trade finance department. I'm part of a great team. A lot of you probably know Debbie Gelbach, Kristen Kyle McQuestion, and I imagine Natalie Sullivan as well. All of us have been in the business in banking and other institutions, organizations for some time now. So I've listed all of our phone numbers and emails. Please reach out to any of us. Reach out to me. Let me know what you thought of the presentation, and if you have any questions, more than happy to work with you. I thank you for my time today. It's an honor to be on this panel. I'm sure you'll enjoy the rest of the presentation. Thank you.
Hello, this is Mabel Lewin with Meridian Finance Group. So I'm basically here to talk about the global demand for export credit insurance and how it's increasing. So let me go into this by setting up the stage for you, so this way we can kind of proceed forward as to how payment terms, open account payment terms can be extended through the use of credit insurance. Next slide, please. All right, and then next slide, please. Okay, so the global demand for exports is definitely increasing. And even though the world economy is experiencing an economic downturn, there are many opportunities for growth, especially through exports. And the main reason is because global financial crisis doesn't actually affect every sector of the economy, and even so, each region is on its own path to recovery. So I kind of listed some examples as to why there's an increasing demand for exports, and of course, one of which is that the U.S. only makes up about 4% of the world's population. So why would you not sell to the rest of the world? And also, there are many free trade agreements that are in place with the U.S. that definitely helps with that, such as with Mexico, Colombia, Australia, and of course, I'm just naming a few. And believe it or not, a lot of exports are actually made through small businesses. Next slide, please. And of course, these small businesses generally face 4 types of payment terms. So this is the sliding scale similar to what Joe had just presented earlier. So basically, this is just a quick snapshot. And here, I'm not going to go through which each item is, but it just basically shows you that spectrum of risk. And as you can see on the left, it's where the seller with open account payment terms is the riskiest, and for the buyer, cash in advance is the riskiest. So I'm not going to go into what each of these items are. If there's questions, please let me know, and I'll go further into it. Next slide, please. So you as the buyer, if you are the buyer, why would your buyer be asking for open account payment terms? So the 3 boxes to the left, because your buyer may actually refuse to pay cash in advance or open a letter of credit because it ties up their cash flow. Many foreign buyers also face very limited access to capital. While the U.S. has a lot of different sources to capital, such as banks, non-bank asset-based lenders, factors, equipment leasing companies, and of course the list goes on, this depth breadth of options don't actually exist in emerging markets. So what do the buyers do? They turn to their suppliers for financing options. And sometimes the buyer could also face high interest rates in their own countries, especially when they're dealing, if they are a small company. And sometimes exchange controls can also be a long and lengthy process. Now, if you take your attention to the other 3 boxes to the right, why would you want to extend payment terms? So of course, you want to be more competitive versus the other suppliers out there. So for example, if there are 2 companies selling a similar product, your buyer is more likely to choose the supplier that's offering more favorable payment terms. net 30 rather than open account payment terms, or than prepayment, or net 60 rather than net 30. And then, of course, you definitely want to develop and support distribution and fill supply chains. You want to get your products out there, on the shelves or, in front of your buyers. And you can also sell larger shipments as well, too, through open account payment terms if that's something that you want to get into. And it also helps you keep your doors open in strategic markets, and sometimes offering open account payment terms is really just the only way. Next slide, please. So let's say you did decide to extend open account payment terms, and what would be your biggest risk? Of course, it's what if I don't get paid? Well, this is a serious concern for a lot of exporters, and even if you do your due diligence by having strong credit standards, like checking credit references, analyzing financials, pulling credit reports, or even doing in-person visits, nonetheless, you can still run the risk of your buyer facing bankruptcy or receivership problems. The buyer could also disappear or become unresponsive to payment demands. And also, some countries do not have a formal bankruptcy procedures like the U.S., so it makes it very hard or impossible to collect. Many buyers may also face cash flow problems or balance sheet issues and start paying slow. 30 days turn into 60 days, 60 days turn into 90 days late. Non-payment can also be engendered by other general economic conditions, either in your buyer's country, here in the U.S., or in the end user's country. Buyers could also face currency fluctuations or foreign exchange controls, where the buyer can go to their central bank just to find out that the hard currency reserves are low, and therefore they can't release any of the U.S. dollars outside of that country. There's also political risks that could be involved, such as expropriation, war, strikes, embargoes, and trade sanctions. Besides worrying about not getting paid, many exporters also wonder how long they actually have to wait to get paid, and definitely this impacts their working capital. So in general, international sales definitely require longer payment terms, which can then tie up cash flows, and their cash flows, and lenders can also exclude this foreign AR from the borrowing base, just basically due to the risk of not getting paid. Next slide, please. So with all those said problems that I listed, of course the solution is export credit insurance, because this allows the exporter to, one, protect their foreign receivables in the event that the buyer defaults in payment, goes bankrupt, pays slow, or if they experience any political risk within the buyer's country. It allows you to confidently extend payment terms so that you could actually sleep better at night. It allows you to be more competitive in the market and to penetrate new markets where you may not have been willing to sell to without the insurance. It also helps increase international sales, because with the insurance in place, you may be more willing to sell larger shipments to your buyers, extend longer payment terms. And lastly, export credit insurance can also act as a financing tool by enhancing your borrowing capacity. This basically gives the lender more comfort in including your foreign AR as collateral. Next slide, please. And of course, where can you get export credit insurance? You can get it through the federal government program, which is XM Bank, and you can also get it through the private sector. So there are definitely different requirements for XM Bank versus the private sector. So I'll just kind of quickly go through a few things. XM Bank has very unique small business policies where they do bend over backwards for smaller exporters. They also provide 95% coverage, which is higher than the private sector. Private sector generally starts at 90% coverage. XM Bank is also open in higher risk markets, whereas sometimes the private sector may be less willing to get into. So, and lastly, with XM Bank, I mean, there's other requirements which we can dig into later, but the biggest thing about XM Bank is it's really meant to support U.S. exporters who are making U.S.-made product that are also shipped out of the U.S. So that's what it covers. And then the private sector it's a little bit more lenient in that regard, where, you know, if you don't have U.S.-made product, or if you are selling to the government, we can go to the private sector because there's no content restrictions. However, there is a minimum annual premium that's usually due up front. Ex-Im Bank is a pay-as-you-go policy, so there's a big difference there, and generally why smaller exporters gear towards Ex-Im Bank. And of course, we can all obtain this through Meridian Finance Group. Next slide, please. So here I wanted to kind of go over the structure of the export credit insurance policies. So first, there are different types. There's, of course, whole turnover, where you can cover your domestic and export sales. There's top buyers, meaning you can cover just your top debtors because they make up the majority of your AR. Or you could do a reasonable spread of risk, where we would figure out what is the best way to structure a policy so that we could get what is needed. You can also do single buyer policies, which is basically after selection. In a way, you can pick and choose which buyer, and we can just do single buyer policies for that one specific transaction that you may have, or one single buyer. Now, premium. In general, premium rates are a fraction of a % of your invoice amount. So, for example, with Ex-Im Bank, with their express policy, it's 65 cents per $100. So, just to give you an idea, it is a fraction of a %. And with Ex-Im Bank, again, it's a pay-as-you-go with monthly reporting. And again, in the private sector, it's generally paid in advance. Now, claim filing window. So, of course, if your buyer is experiencing bankruptcy or insolvency or any political risk that you have, there's no claim filing window. You can pretty much submit a claim immediately. Now, if it's a regular day-to-day business type of transaction where your buyer just doesn't pay you, or they're late in paying, there's a time period where you would submit a claim within that period, and then should it be approved, it can either go back. Basically, the claim proceeds will then be paid back to the exporter or to the lender if they're the assigned beneficiary on the policy. Now, going into buyer approvals, there's different ways, there's different types of buyer approvals overall. So, of course, you can get every buyer reviewed and looked at, and then they get plugged into a policy that's called named buyer. And then you can also get something called a discretionary credit limit, where that allows, where the underwriters will then predetermine a specific amount that you're approved up to, and then you can just go ahead and internally approve that buyer up to that specific amount without submitting it in for a formal approval with the underwriters. So from there, it kind of gives you a little bit more leverage, and usually that works well for companies who need a quick answer from the underwriters. And also, the nice thing about this is with any of the policies, they're all pretty live, and by what I mean is, you can submit buyers at any time, or during the policy period, increase any limits at any time. So it works. So it's meant to work with you as the exporter and plug along as your sales go. Next slide, please. And these are just other things that we offer in trade finance. So just a little quick list. And my contact information is below. And if you do have any other questions, please feel free to reach out to me. And I will get back to you as soon as possible. Thank you.
Good morning. This is John Brislin from the Export-Import Bank of the United States, Seattle Regional Office. Could you forward the slide, please? Forward the slide again. This is Ex-Im Bank's new tagline, reducing risk, unleashing opportunity, as well as our new logo, which was shown at our annual conference. Next slide, please. Ex-Im Bank, my agency, is the official export credit agency of the United States government. We're a self-sustaining and independent agency. We were established in 1934 during FDR's first term. We're headquartered in Washington, D.C., and we have 12 regional offices across the United States, including one here in Seattle, Washington. Our mission is to support the sales of U.S.-made goods and services to create and maintain U.S. jobs. Next slide, please. Again, here's where Ex-Im Bank's financing and risk mitigation support can make a difference. We can help minimize risk, level the playing field, as well as supplement commercial financing. Next slide, please. Basically, our products really fall into 4 groups based upon needs. The first one would be risk protection, again, where as well as extend credit to foreign buyers. And again, this is largely where we speak to our export credit insurance programs, which Mabel Luen from Meridian, who's one of our brokers, spoke previously about export credit insurance. The next group of products we provide is working capital programs, where we support a bank to provide you, the U.S. exporter, with a working capital line to be able to fulfill foreign orders. And the third group of programs we provide is term financing programs, where Ex-Im Bank provides guarantees or insurance to a lender to induce them to provide a medium or long-term loan, or possibly direct loans to the foreign buyer in cases where we can't get a commercial bank interest in supporting the transaction. Next slide, please. First solution, export credit insurance. And again, Mabel spoke about this pretty eloquently. Again, we're providing an insurance policy to you, the U.S. exporter, to cover both commercial and political risk on an export transaction. This allows you, the exporter, to safely provide extended payment terms to your foreign buyers of your goods and services to export. Next slide, please. Again, I just have pictures where Mabel had great words. Again, the 3 talking points about export credit insurance is that it's a risk mitigant tool for you, the exporter. It's a sales and marketing tool, again, which Mabel mentioned, as well as it's a financing tool, because, again, the insurance with the enhancement of your lenders, such as Banner Bank, who's helping to host us, is very savvy about working with our export credit insurance to help provide you with financing. Next slide, please. And again, we've got 4 groups of products that Mabel did speak about groups, but again, we've got an express insurance policy, which is for a small business exporter with 20 or less buyers they're selling to on extended payment terms, and they have less than $7.5 million in export credit sales. We've got a small business multi-buyer policy where the exporter, again, is still a small business with less than $7.5 million in export credit sales, but they have more than 20 buyers who they're selling to on open account terms. Our standing multi-buyer, which could be experienced exporters of any size, and then we have single buyer policy options where it provides insurance coverage for one foreign buyer for a series of shipments over an entire year. Next slide, please. Second solution we provide is a working capital guarantee program. We provide a 90% guarantee to a lender, and Jim's going to go in depth more into this program because my good friends at the Small Business Administration also have a working capital program for exporters. Again, what we do is we provide a guarantee to a lender. The lender in turn can provide a loan to you, the U.S. exporter, which enables you to purchase or manufacture U.S. goods or provide services for export. And again, the benefit of this is that the lender can provide you, the exporter, with higher advance rates against your inventory and accounts receivable, and you will have the capital to be able to fulfill those large export orders when they come in. Next slide, please. Again, the purpose of the program is to assist small and medium-sized businesses to obtain working capital to be able to produce or purchase the goods and services for exports. Ex-Im Bank's working capital program is an asset-based loan where it's fully collateralized. Again, we can set it up as a transaction-specific or revolving line of credit. With Ex-Im Bank, there's no minimum or maximum amounts, and again, the advance rates. Our loan guarantee will allow a lender to support advance rates of up to 75% against export-related inventory, meaning raw materials, work in process, and finished goods. And our loan support will also support advance rates of up to 90% against foreign accounts receivable. And again, the U.S. Small Business Administration, SBA's advance rates are also the same. Next slide, please. Again, here's a chart with an example of a company that has $2 million worth of collateral with a combination of inventory and receivables. In the middle is an example of a bank providing financing without an Ex-Im Bank or an SBA guarantee. This slide really should say Ex-Im Bank or SBA because, again, we're providing the advance rates. Typically, with work in process, for example, as you see in the slide, banks typically will not advance anything against it. Finished goods, 50%. With Ex-Im Bank or SBA, you can see the advance rates move up to 75%. When you look at open account, foreign accounts receivable, a bank typically advance 0. With an Ex-Im Bank or SBA guarantees, 90%. So here's an example with $2 million worth of collateral. A bank conventionally providing a loan without an Ex-Im Bank or SBA guarantee could provide it probably advance rates up to $760,000 of that $2 million collateral base. With an Ex-Im Bank or an SBA guarantee, it boosts it up to 1.65 million. So again, it allows the U.S. exporter to borrow more with less. Next slide, please. Again, our third product solution, again, this is on the buyer financing side, is medium-term financing. In this case, Ex-Im Bank can provide insurance or guarantees to a lender. The lender can in turn provide financing to the foreign buyer. This allows the U.S. exporter to obtain payment when the goods are shipped, and generally it's used to support the sale of capital equipment. This typical structure per the OECD, which is the Organization of Economic Cooperation and Development, which is a club of all the major export credit agencies across the world, Ex-Im Bank being the U.S. official export credit agency. We have agreed upon rules. The first rule is that there has to be a 15% or 1 to 5% down cash payment required on the foreign buyer, and then 85% balance can be financed by the lender. In Ex-Im's case, we'll finance the U.S. portion of the transaction. And again, in the medium term, repayment terms can typically be 2 to 5 years. It can be extended exceptionally out to 7 years if the products fall within the renewable sector. And the loan size amount is typically $10 million or less. Next slide, please. Solution number 4, again, our long-term financing. In this case, Ex-Im Bank can provide a guarantee to a lender. The lender can provide financing to a foreign buyer. Or if we can't induce a bank to provide the financing, Ex-Im Bank can provide a direct loan to a foreign buyer. And again, in this case, as the other cases, the U.S. exporter can obtain goods when the payment when the goods are shipped, and in some cases the product's set up. Again, this can also be used to support the sales of very large items such as aircraft, of which we know a lot. There are a lot of Boeing airplanes flying in the sky. And we can do project and structured finance for things such as power plants, for example. And again, we still require that 15% cash down payment required on the foreign buyer, and we can finance that 85% portion to be financed by the lender. Again, the repayment terms for the long-term transactions is typically 7 to 10 years, but exceptionally we can go up to 18 years, for example, for a solar power plant or something like that in the renewable sector. And the loan amounts are generally more than $10 million. Next slide, please. And again, some restrictions Ex-Im Bank has. We were founded in 1934 under the FDR administration. The Congress at that point was concerned that we were going to finance the European powers for World War II. So we have some prohibitions as far as the support of export finance and insurance support for defense articles or services or sales to military buyers. But that being said, we look at the transactions on a case-by-case basis. So we've been able to support transactions. We're exporting goods for humanitarian purposes, drug interdiction, or dual-use items. So, for example, Ex-Im Bank has provided guarantees to support lenders to finance foreign military to buy aircraft for drug interdiction purposes in Colombia, or patrol boat vessels in the Caribbean, as well as some dual-use items. So again, if you have a question in regards to whether the goods will qualify for Ex-Im Bank support, certainly you can reach out to Banner Bank, or certainly come to me directly, and we will check with our engineering department and qualify whether it could follow for Ex-Im Bank support. And again, where I mentioned where Ex-Im Bank's mission is to support the export of U.S. goods and services, we have content requirements. So, for example, in our short-term insurance programs, for example, the goods have to be really 51% U.S. content. Now, that doesn't mean each item on an invoice has to be 51% U.S. content. We can allocate it on an invoice basis. So, for example, you could have a shipment of goods of which is 49% Canadian content and 51% U.S. content, and we can qualify the whole invoice for Ex-Im Bank support on the whole invoice. And again, under the medium-term and long-term programs, again, we're looking for a minimum of 85% U.S. content. In cases of things like airplanes, for example, we have the ability to do co-financing. So, for example, if Boeing goes to sell a jet to Lion Air in Indonesia, and Lion Air wants a Rolls-Royce engine on that, we can do a co-financing with the UK's Export Credit Agency, where they're doing a smaller loan for the engine. We're providing the larger loan for the entire airplane, and the Lion Air gets one loan through Ex-Im Bank at one price. But again, there's two export credit agencies involved with a loan. And again, in regards to service exports, because again, Ex-Im Bank can support the exports of services, the services need to be performed by U.S.-based personnel, either in the U.S. country and the host country. That being said, they're not required to be U.S. nationals. the U.S.-based personnel, they need to be employed by the company here in the United States. They could be U.S. or foreign nationals, either working here or overseas. Next slide, please. Ex-Im Bank also, we have a country eligibility, so we're open for business and support in over 155 countries. Sometimes we're closed in countries for either political or economic reasons, and we have a country limitation schedule on our website where it lists whether Ex-Im Bank is open for short-term transactions, which could be up to a year, medium-term, again, 2 to 5, exceptionally out to 7, and long-term 7 to 10, exceptionally out to 18. And we speak to whether we're open for sales into the private sector buyers, or public sector. Because again, a lot of companies are not only selling business to business, you could be selling business to government. So again, Ex-Im Bank can support both. Next slide, please. And again, here's some contact names. We've got 20 people in the field, and those are our offices across the country. I'm up there, so I'm third down from the top. So again, we've got 3 in the western region. We've got 5 offices in the central region and 3 offices in the eastern region. And again, we oftentimes travel and cover multiple states. I cover both Washington State, Idaho, and Alaska, and I back up in Oregon as well. Next slide, please. One of the things I wanted to point out is that Ex-Im Bank, our small business group, has developed some e-books and videos which speak to exporters on our product offerings. So again, the first book we have is our Export Expertise, 10 Finance Tools to Grow Your Export Business that you can avail yourself to. There's the link. We have an e-book and a video on our export credit insurance products. Next slide, please. We've also developed e-books on our working capital loan guarantee products. Next slide, please. There's my contact information if you need to reach back to me. Again, I'm a resource. If you come to me and I realize that you might not qualify for Ex-Im Bank support, or there's a resource that you need, I can connect you with. In the federal government, we have a no wrong door philosophy. So if you come to me, instead of saying no, I'm going to tell you not now, or here's who you need to speak to. So thank you very much.
Good morning. I'm Jim Newton with SBA's Office of International Trade in Portland, Oregon, at the Portland USIAC. As John indicated a moment ago, both SBA and Ex-Im Bank, I apologize. I should have called for a slide. I don't know if we can restart here. Okay.
Oh, yeah, we can restart. One sec.
I'm sorry, I didn't call for the slide, and I was talking to the cover. I apologize.
Oh, that's okay.
I'll
I try to intuitively follow along here. I'm going to stop.
Good morning. This is Jim Newton. I'm with SBA's Office of International Trade in Portland, Oregon, and office at the Portland USIAC. As John had indicated a minute ago, if you would, in fact, go ahead and the first slide. As John indicated a moment ago, both SBA and Ex-Im provide a working capital guarantee for small businesses, and in the case of Ex-Im, for mid-sized enterprises as well. But we both provide a working capital guarantee to the benefit of small business exporters, but it is actually issued to a lender, and it is the lender that determines which of the programs it wants to utilize, which whether SBA or Ex-Im, and the set of circumstances that would determine if it is a working capital facility or possibly a term loan. But either case, the lender will make that determination, will fund the loan, and will service the loan. In the case of what is the real motivation for these guarantee programs, it's intended as a risk mitigation for the lender to make them a little bit more comfortable in providing this working capital financing for U.S. exporters. But it's really intended to provide you with access to capital, and as John was illustrating a little while ago, to increase your borrowing capacity based on the advance rates that are available under these programs. at least what we encourage the banks to make available. Next slide, if you would. SBA's export guarantee guidelines are, as shown, they're a maximum of $5 million for any of our programs. XM goes beyond that, up to $10 million under their delegation, and beyond that for their super delegation and for board level consideration. But for SBA, we max it out at $5 million, which we feel is ample for most small businesses. We do not have a U.S. content requirement, nor do we have a restriction on military exports as long as they're properly licensed. We do ask or expect the business involved to have been in operation for at least 12 months. It does not have to be profitable, but in business. And we will also consider the experience of the owner-managers, having been with other similar businesses. We and there are occasions we will waive that one-year requirement on that basis. But all of the guarantees offered by XM and SBA for export purposes are at a 90% guarantee level. I'll make a slight exception to that in a later slide, but for the most part, 90%. What is a small business? From the SBA's perspective, we have historically used employee count as the size determination. And for manufacturers, that went all the way to 500. So it covered most manufacturers, at least as the case here in Oregon, and only 5 with more than 500 employees. But for service companies, architectural service companies, for procurement firms, there was a need to provide a little bit more flexibility. So we created an alternative size test based on capital and income. As you see, tangible net worth less than or equal to $15 million, and it's a conjunctive statement here, and prior to-year average net profit after tax less than $5 million. Next slide, if you would, please. As far as the programs offered by SBA, as I was mentioning, we do have the Export Working Capital Program, very similar in nature to that at XM. I'll go into some of the distinctions here in just a minute, but that is our primary trade finance driven program. We also make available, because we are SBA and we do term loans largely through our domestic programs, we do make available an international trade loan, which is intended to be used for the acquisition of plant and equipment. For equipment, it goes up to 10 years. For plant, it can go up to 25 years. But it is done as a standard term loan, installment repayment, and just like a mortgage. And it is intended for U.S. exporters. So it's intended to both improve their competitive position for exporting, as well as any companies that are adversely impacted by foreign imports. This loan is structured much like the conventional 7A program, but it does require that the company involved establish what their export plan is going to be if they're not already exporting, and a projection of what their export sales results will be over the subsequent year or longer, but at a minimum 1 year. Also, the Export Express program is geared to a more streamlined approach to delivering the financing through the banks, and it can actually be used as either a term loan facility like at the International Trade Loan for up to 7 years in the case of Export Express, and can be actually extended out to 10. And can it also be used for plant purchases if needed for out to 25 years. But it can also be structured as a line facility for 1 year at a much lesser cost as far as the guarantee fee. If you would, go ahead and go to the next slide. And I want to discuss some of the specifics of the Export Working Capital Program that we make available to small businesses. And I want to emphasize that, in my opinion, This is our greatest value added program in terms of assisting small business exporters who need access to capital to undertake that large incremental sale or to begin to build their export base. It is a one-year revolving line of credit and can be used for either pre or post-shipment working capital financing for the export of goods and services. And it can be done in one or two ways. It can be done as a financing against the purchase order, contract, or letter of credit on a transactional basis where the advances are made against the face value of that contract. It can also be done as an asset-based loan, ABL, and it would be using a conventional borrowing base. You would present a monthly borrowing base certificate based on the inventory and foreign receivables, or I should say the export-related inventory and foreign receivables that you currently have in as part of your statement, and that is presented as the basis for advances. In either case, transactional or ABL, this can be used for exporters that are selling indirectly into the export market. In other words, you're selling to a third party, either an OEM or an export trading company, and it can be documented that the product you're supplying is going through to the export market. If you're making parts for Boeing or General Dynamics or for whomever, this would be applicable to you, and you get the benefit of the 90% guarantee, which can often essentially put it over the top as far as making the bank sufficiently comfortable to provide the financing. Next slide, if you would, please. SBA and XM will accept all of the following payment terms from your foreign buyer, whether it be cash in advance, where clearly we're as comfortable as you are with that scenario. Letters of credit are quite acceptable as well. Documentary collections gets a little bit more of a gray area because you're assuming a little bit more risk to the buyer, and in some cases we may expect you to arrange export credit insurance even under a documentary collection, especially if it's on documents against acceptance, where you're really accepting exposure for an extended term, 30, 60, 90 days. Looks a lot like an open account, as was being described there earlier by Joe. And then finally, something we actually encourage is open account terms for your foreign buyers to improve your competitive position. And we're speaking to that both with and without export credit insurance. More often with, because we want that added comfort level. It's really protection for you, the exporter. You're the insured. You get the benefit of a claim payment if needed. We're looking for it to fill the gap from any cash flow deficiency you might have because of the non-payment from your foreign buyer. So it's your protection, but it does certainly benefit the bank and ourselves. We will go out on an open account without export credit insurance in the case that you're selling to a multinational corporation that has substantial resources, or a company that you've been selling to on a recurring basis over an extended term. Realistically, 3 years of good ledger history would be sufficient for us to consider waiving the export credit insurance requirement on open account sales. That's on a case-by-case basis, but it's certainly something that we can provide. Next page, if you would, please, or next slide. The collateral requirements for our export working capital program for SBAs, and this is again similar to XM, though not entirely. I'll try and explain the differences, but we both will assume a first priority lien position on your export related assets, going back to the export inventory and foreign accounts receivable. We would expect to have an assignment of any proceeds from the underlying contract, export contract, or letter of credit. It's easier to obtain that on a letter of credit because the documentation is there, but nonetheless, we would expect an assignment of the proceeds from your foreign sale. We'd also expect an assignment of any insurance proceeds that you might realize from filing a claim on your export credit insurance. so that it does flow back to our benefit for repayment. And I say to us, I'm really speaking to the bank and SBA as guarantor. And for SBA, this is a hard and fast. We do expect that any beneficial owner of 20% or more of the borrowing company will provide personal guarantees or corporate guarantees if applicable. We do not, we SBA do not waive that corporate requirement or the corporate guarantee requirement for venture capital firms. Ex-Im Bank will, and they will also consider waiving if in fact it's a customary practice of the lender to not require guarantees of certain parties, and will accept that, or excuse me, Ex-Im will accept that. SBA, however, does expect any beneficial owners, 20% or more, to provide their guarantees. Next page, if you would, please. As far as possible uses of the Working Capital Guarantee Program, it can be used to issue standby letters of credit as bid bonds, performance bonds, advance payment guarantees, and we have structured this in a way to help preserve as much capital for the company as possible to maintain as much liquidity in the transaction for the company by requiring only a 25% collateral coverage on these bond placements under a standby letter of credit. And we coordinate that usually with the lending bank is going to be the issuer of the standby, but it could be a third-party bank as well, in which case the 25% cash collateral will need to be posted through that or to that third party. But it can ultimately be displaced by inventory and receivables that are created through the transaction, and it can displace the cash requirement to free up additional capital. If you would, the next slide, please. The working capital fee structure for the Export Working Capital Program is actually pretty nominal. For a 12-month transaction, it's a guarantee fee of 1/4 of 1% of the guaranteed amount, and it can be renewed at the end of the initial one-year term for a like amount for 1/4 of 1%. So what we're keen off of there is the fact that this is somewhat of an exception to SBA's other programs, which are typically the longer-term facilities. And here we're looking at a short-term 12-month facility for the large part self-liquidating. And so we make that allowance for a much lower fee requirement, and we're still operating below subsidy because we have a very low loss rate on this program. I should point out the borrower does negotiate the rates and fees with the lender. This is the only program that does not have a cap on the rates and fees that the borrower would pay to the lender, but we do state that they have to be reasonable. Whatever that may be, it does have to be reasonable. Next slide, please. And I want to also highlight, if I can say it, highlight the alternative approach, the asset-based or ABL approach that, well, actually, excuse me, let me go back here and we'll highlight the transaction-based approach first and then the ABL. We'll come back to that. If you would, next slide, please. And we'll go into the particulars as it relates to the transactional or contract financing. And that is that you can actually finance a single export order or contract or multiple export orders. So it can be a standalone transaction or it can be as a revolving line of credit for multiple orders. And each is presented as available and then reviewed by the bank and whatever guidelines set by SBA for the subsequent orders. No funds are dispersed until the purchase order is signed, understandably, but we can set the process in motion and loans can be approved for pending orders. So the bank and SBA can both position to the award of the order or contract, and you have the benefit of knowing what your pricing is going into that order, and in fact factor it into the final purchase order. knowing what the costs are as it relates to both SBA and your lender. The payments coming in from the foreign buyer that, as I mentioned, need to be assigned to the lender and to the benefit of SBA, that those payments will actually be applied against the outstanding principal of the loan through a cash collateral account. So they are controlled collections. Again, all part of that concept of a self-liquidating line of credit, just what the Medicis were doing in the 1400s. So then it frees it up, and you apply it back against the loan. You have then new availability on a revolving basis or on a single transaction. It does, in fact, become a self-liquidating loan. Next slide, if you would, please. This is the other aspect of the EWCP program I wanted to highlight, is that we will actually finance up to 100% of your cost of goods sold and overhead expenses. So all of your direct and indirect expenses, excluding your profit, can be financed. Covers essentially all the costs associated with this transaction or set of transactions to help provide you with the capital you need to do additional export sales above and beyond your conventional domestic sales. And I should highlight also that the cannot exceed 90% of the export purchase order or contract or letter of credit, so that if your gross margin is something less than 10%, then it's not going to make it within this guideline. But otherwise, it does allow for financings up to 90% of the face value of that contract on a transactional basis. Next slide, please. And we'll now look at the ABL approach, asset-based. Next slide. In the case of SBA's Export Working Capital Program, we have the same guidelines and advance rates as the case with Ex-Im Bank's Working Capital Guarantee, so that we're allowing for advances up to 90% against eligible foreign receivables. Again, they can be either insured or non-insured, but they do have to be within a certain maturity date. They can't be in excess of 90 days from invoice date. So it does have certain constraints on it, as it would with any bank financing. But we're saying to the bank, basically, you can provide up to 90% and still maintain your position to use the guarantee. And then finally, on the export inventory, we're saying up to 75% across the board. As John highlighted before on his exhibit, up to 75% on raw materials, on work in process, which often is not even included in the borrowing base on conventional financing, and finally 75% on finished goods. We do have an annual ABL fuel exam to go back and take a look at the borrowing base certificates and the basis for those as submitted by the borrower. We do that on an annual basis. Ex-Im actually has a semi-annual requirement, and we both set it at any financings over $1 million. The final slide, if you would. This is my contact information. I also have that of Larry Trujillo, who is the District International Trade Officer for Portland and the state of Oregon, as well as Southwest Washington. He is my backup when I'm not available. If I'm off in Montana or Hawaii or wherever, you can certainly call on Larry as well, and he'll be able to assist you just as well, or you can get in touch with me in most cases by my cell. Unfortunately, I didn't put that in there, but nonetheless, you can, I'll have it out there on my message if you're calling the office. And that you can utilize to give me a call if you have any questions, or if you have a transaction you'd like to discuss, I'd be glad to do so. Thank you very much for listening, and let me know if we can be of assistance. Thank you very much.
Thank you, Jim, and thank you everybody for joining us here today. Really appreciate all the great information that our speakers shared with us today. Definitely provide some wonderful resources for companies looking to mitigate their risk with exporting. And also a special thank you to Banner Bank for hosting this event today and bringing all these great resources to us. Thank you. The webinar has now ended.